Your bank account is essentially a ticking time bomb as $1 trillion in credit card debt officially poisons the American economy. This isn't just poor budgeting, it is a calculated structural collapse designed to make borrowing our only path to survival. We are peeling back the psychological traps and legislative shifts that turn debt into a permanent, unavoidable lifestyle, uncovering the specific, ignored mechanism hidden in the fine print of every statement. Glass of water, and let's get to it. To understand why debt is everywhere, you have to look back to the mid 20th century. Before the 1950s, credit was for the wealthy or the desperate. Buying something on time was seen as a moral failing. If you didn't have the cash, you didn't buy the goods. It was a rigid, cash based reality. Then came the Diners Club card in 1950. That one piece of plastic changed the human relationship with money forever. Here is the first point you need to grasp. The transition from cash to invisible credit was a psychological masterstroke. Economists have studied this extensively, and the findings are consistent across decades. When you pay with physical cash, your brain registers the physiological pain of loss. It is a real, measurable stress response. You are physically handing away a piece of your value. But when you swipe a card, that pain of paying vanishes. A famous study from the Massachusetts Institute of Technology asked participants to bid on tickets for sporting events. The group that used credit cards offered to pay up to 100% more than the group using cash. Think about that for a second. People literally valued the exact same item higher simply because the medium of exchange made the money feel abstract. You are not spending dollars anymore. You are spending digital points, and those points feel infinite until the bill arrives. This is the foundation of the modern consumer trap. It is not just about needing stuff. It is about how the mechanics of payment mute your natural hesitation to spend. Now, let's move to the second mechanism, which is arguably more damaging than the first. If you're finding this breakdown helpful, hit subscribe. I release deep dives like this every single week. We are moving into the world of algorithmic lending, and this is where the system shifts from passive to predatory. You might think your credit card offer is a standardized product, but it is actually a weaponized piece of data science. In the past, banks made money primarily on interest. Today, they make money on interest, swipe fees, late penalties, and most importantly, selling your spending data. They know your habits better than your spouse does. Consider the case of the late payment trigger. Software now monitors when you are most likely to be low on funds and initiates a specific kind of digital pressure. If you carry a balance, the bank does not want you to pay it off. They want you to pay just enough to stay in the game so they can keep collecting the high yield interest. According to recent data from the Federal Reserve, the average interest rate on credit cards has climbed toward 25%. When you compound that over time, a modest purchase effectively doubles in price. This is the minimum payment illusion. By setting your required payment low, the bank keeps you in a state of perpetual interest accrual. They are essentially farming your future income. It feels like a convenient way to manage your cash flow, but it is actually a slow motion wealth extraction machine. You aren't just buying the product, you are signing up for a monthly tax on your own life. Okay, remember how I said there was a third point, the one that most people miss? This is the one I've been saving for you. We have talked about the pain of paying and the data science of interest, but the real secret to why Americans are trapped in debt is the systematic dismantling of the social safety net. This is the hidden elephant in the room. Over the last 40 years, the cost of essential services, specifically healthcare, housing, and higher education, has outpaced wage growth by a factor of nearly 4. When the cost of basic survival items spikes, your only two choices are to cut spending or to use credit. But for the average family, there is no more spending to cut when an emergency happens. A flat tire, an unexpected dental bill, a car repair. That is no longer a minor annoyance. It is a crisis. Because household savings rates have plummeted, these emergencies are almost exclusively funded by credit cards. A report from the Urban Institute found that nearly 1 in 3 adults in the United States carries debt that has been sent to collections. Think about that number. 1 out of every 3 people is not failing because they are bad at budgeting. They are failing because the system has made basic survival unaffordable. We have effectively turned credit cards into the American welfare state. When you can't pay for your emergency room visit, you put it on a card. When your rent hikes up, you put the groceries on a card. The entire system is built to ensure that when your income can't cover your life, you stay afloat by borrowing from your future self at a massive markup. This is why debt isn't going away. It is not an individual moral failure, and it is not a lack of willpower. It is a structural requirement of a society that has offloaded the cost of essential living onto high-interest consumer credit. Once you see it this way, you can't unsee it. You start to realize that every swipe is a small vote for a system that keeps you on the treadmill. So there you go. We covered the psychological numbing of credit, the algorithmic harvesting of your interest, and the massive systemic shift that turned credit cards into our only real safety net. That third realization is the most powerful one because it changes your relationship with your debt. You stop blaming yourself for being human and you start seeing the design of the game. If you got value from this, share it with someone who is currently feeling the squeeze of this system and subscribe so you don't miss the next deep dive. We are going to keep peeling back these layers. Thanks for sticking with me. I will see you in the next one.